Smooth 98.1. This is Business Express. We're looking at everything related to business, finance, and of course, the economy. And I would love for you to be a part of the conversation as well. This morning, we're talking about health. Okay, not that kind of health. The health of banks in Nigeria. And let you know how you can be a part of the conversation. We're streaming live on our YouTube channel. It's Smooth 981. So you can just catch the live stream, post a comment on there as well. And don't forget to subscribe. You can also tweet at Smooth981. The hashtag is Business Express 981. And you can send a message through via WhatsApp. 0809 440 and 981. We have a special guest joining us this morning as we're talking about the health of Nigerian banks in the first quarter 2024. Our guest is Ngozi Odum. She's a banking analyst, CardinalStone. Good morning, Ngozi, and welcome to the Smooth Breakfast and Business Express.
Good morning. Thank you for having me.
So it's very interesting. I can't ever recall having a conversation with a female called Ngozi because that's my first name as well.
Okay.
So it feels strange saying good morning, Ngozi. I feel like I'm talking to myself.
I get that.
All right. Okay, let's get into the conversation. Ngozi, how would you describe the health of Nigerian banks following the devaluation of the Naira in June of last year?
So when we look at banks' health, and we can infer the health status for banks using their capital adequacy ratio, we'll say that they were pretty much relatively healthy health-wise. If you look at banks' capital adequacy ratio, even with the advent of the devaluation of the Naira as of June 2024, their capital adequacy ratios for the banks that published audited results show that at least for tier ones, capital adequacy ratio was on an average not of 20%, and the statutory limit is around 15%. So you can infer that banks still remain relatively healthy. I mean, there are upside risks to banks' health, but it goes along with the business of banking. But at that point, it remains relatively healthy.
Okay, this is something that might confuse some people, right? Because banks are sitting on these dollar assets that continue to grow in value after devaluation, but they also have the dollar liabilities, which would also grow after a devaluation. Is this why they would need to raise capital?
Not necessarily, not necessarily. So for banks' capital, or how we look at it, their exposures, foreign currency exposures, they have the asset leg and they have the liability leg. So with the movement in the Naira, a devaluation in this sense, the foreign currency assets also move as well as the foreign currency liabilities. And what we had seen in the past is that because most banks were in net long position, they were able to, boost their FX revaluation gain, which kind of trickled to their profit or loss statement, and also moved over to their retained earnings in the form of their higher shareholders funds. So in a sense, not necessarily what we would expect going forward with the new CBN regulation for matching FCY assets to liability is that banks' assets would have to be reflective of their FCY liabilities, and that might in turn have to reduce or moderate their FCY exposures in terms of asset size as they begin to unwind those excess long positions, but not necessarily. The movement in assets and liability kind of match each other in terms of currency movements.
All right. Yesterday we spoke about GTCO. I'd really like to get your thoughts on the Business Day newspaper story that said the bank could, do a rights offer.
Okay, so in terms of doing a rights offer, for GTCO, it came quite unexpected because, like I said, when we looked at banks' health status and their capitalization amount, GTCO is pretty much in a comfortable position. As of its last audited reports, GTCO had a capital adequacy ratio of around 24% and shareholders' fund in excess of 1 trillion. So that in itself puts GTCO in a comfortable position capital-wise. But in the bank's decision or possible decision, because we don't have confirmation yet, to explore a rights issue, I mean, it's not quite far off. The only thing will be the intention for the capital raise. What will be the intention for the capital raise? Is it to fund business expansion? So that's what investors will be looking at. Where are the proceeds of this offer going to be used or deployed?
All right. We're speaking with Ngozi Odum, banking analyst, CardinalStone, and we're talking about the health of banks in the first quarter. The Monetary Policy Committee raised the benchmark interest rate to 22.75%. Ngozi, can you define the net interest margin for a bank and how the higher rate would affect it?
Okay, so how you can look at net interest margin, look at it as a profitability ratio. So we know that banks are in the business of, financial intermediation. So they provide, they take deposits from customers and they provide loans. So look at it in the interest income that they, receive from providing loans, as well as when you take out the interest expense based on what they have to do to obtain deposits. If you net it off, you net off your interest expense from your interest income, you're left with your net interest income. That as a proportion of your interest earning assets is what is your net interest margin. So pretty much it's a ratio to just say how much the bank is generating over its interest earning assets after it has taken or it has accounted for its interest expense or its cost of obtaining deposits.
All right. So where does this leave us, regular folk who are the banking customers? I mean, what does the higher rate mean in terms of loans and even earning returns on securities?
I mean, it's positive. It's generally positive. What it means is that CBN has a statutory ratio for banks to a minimum for savings deposits, which is 30% of MPR. So with the movement of benchmark policy rates to 22.75, what it would mean is that you're going to be enjoying higher interest on your savings deposits, as well as other forms of deposits or other forms of funding. So the benchmark policy rate kind of gives an idea of where consumers should be enjoying in terms of interest rates movement. So higher interest rates is beneficial. Also, when you look at the fixed income side of it, you see that NTB at the last auction, effective yields on 1-year NTB was printed around 22%, not of 20%. So that's still positive for investors. So higher interest rates means you're able to enjoy higher interest on your funds.
We're speaking with Ngozi Odum, banking analyst, CardinalStone, and we're talking about the health of Nigerian banks. If you've got a question or a comment, please send it through. The WhatsApp number is 0809 444 981. You can also tweet at Smooth981. And we're streaming live on YouTube as well, so you can catch the live stream, post a comment, and even save it for later. Okay, looking at the stock market, is it still attractive considering that the rates for fixed income and money market securities are rising?
I mean, it depends on your position. So I get the attractiveness of fixed income because for investors that are less risky, I mean, it offers an attractive position when you see effective yields, like I said, on 1-year ATB printing north of 20% levels is more attractive compared to equities with the associated risk. However, how you should look at it is that especially when you play in fundamentally sound names, if you look at the banks, for example, you're able to participate not only on capital appreciation angle, but also in terms of dividend yield. So if you factor both of those sides together, you see that there's still attractive opportunities. I know up until yesterday where we saw some recovery in banking names, pretty much towards the end of last month, we saw banks were pretty much on the sell side. So that could have given investors an attractive opportunities. Also, we're seeing positive sentiments are surrounding new listings and all of those exciting disclosures really spur sentiments in the market. So it depends on how you're able to approach your investments in the equity space. There are still profitable returns. And then when you look at your dividend yield, if you de-annualize it against fixed income returns, you see that you're able to enjoy higher yields in a shorter amount of time. So there are still some attractive play, but it depends on the investor and their risk appetite as well as their approach to investments.
Okay, so let's talk about portfolio diversification. Is that the right move right now for local investors? In fact, can you actually define portfolio diversification?
So diversification in a sense is about varying your investments. So you can diversify based on different asset classes. So equities, fixed income, real estate, alternative securities. So you can diversify based on apportioning a certain amount to various asset class. And then even within the same asset class, you can also still diversify or vary your investments. So for example, in equities, you can diversify even in the equities market by playing in different sectors. You can apportion different amount of funds to various sectors, for example, consumer goods, industrial goods, banking, insurance. So in a sense, what it does is that it makes your portfolio more resilient. So in the case of shock or cyclical shocks or business shocks that may happen from time to time, your portfolio is able to, resist declines because you're in the various asset classes, and the expectation is that what affects one sector might not necessarily be what would affect another sector. So in that sense, it gives your portfolio some sort of resilience.
All right, thanks for that. Finally, Morocco, I don't know why you're calling me on WhatsApp video. You can catch the live stream instead. All right, it's on YouTube, Smooth 981. Okay, that is it. Let's see. Fine has sent a message across. Fine says, did I hear you guys say we're able to enjoy higher interest rate on our deposits due to increased interest rates? In Nigeria, we only see deductions on our deposits instead of increments. These deductions are called maintenance charges. Okay. And finally, I want to ask this, Ngozi, just before I let you go. GTCO has not confirmed the business day story yet, but do you think perhaps other banks will need to raise capital as well?
They might. I mean, we can't rule that out, but I think the most important focus should be on, at least for investors, what they are really concerned about is the deployment of said capital. If it's going to be deployed to bolster capital ratios and also improve business expansion. What really investors are looking at is your return. So at least not even in the immediate term, but in the near term, the expectation is that we should be seeing higher returns just with the capital injection. So if we're going to see more capital raises, I mean, that's not unlikely. But I think the focus will be on the intention for capital injection.
All right, I've got a message from Gilbert Musa from Festac. He says, "Are banks in Nigeria currently supporting SMEs? In 2001, there was a CBN directive for banks to contribute 10% of their profit before tax to support SMEs in Nigeria. Was this directive adhered to till date?" And Gilbert goes on to say, "I doubt." Because do you have any information on this?
Well, I don't have the specifics of the directive that he mentioned, but I think if you even look at banks loans, you see that a portion is always in retail, small businesses, depending on the category. So yes, there are intermediation within these sectors, but I mean the question is to what extent do they, facilitate loans for all of these sectors?
All right. Well, that is all the time that we have for Business Express this morning. Thank you for your messages. Thank you for listening. And special thanks to our guest, Ngozi Odum, banking analyst, CardinalStone. All right. That is it for Business Express this morning. Stay with us. There's a lot more to come on the Smooth Breakfast.